I'm having a hard time finding bargains. I think Brad has a few companies that he really likes today.
Self-storage REITs have done very, very well over time. And we believe, again, they've been beaten down.
Unlike most buildings, these are kind of build and forget.
Public Storage is the largest, most dominant player. They've got 3,300 facilities.
Every time there's a big migration that occurs, there's a lot of demand for storage centers.
And you've got over 12% of the U.S. population now utilizing self-storage.
Rates are definitely falling. That's good for REITs. It's good for utilities. Good for consumer staples.
Hello, everyone. It's Brad Thomas, and welcome back to the wide-moat show. I'm here in New York City today, so we kind of got a special edition, and good to see my co-host here, Nick Ward.
Yeah, I'm at home where I always am. Happy to be here, but happy that you're in New York. Happy you made it there safely. What are you doing in New York, Brad? Anything interesting?
Well, I just got here, and I'm almost didn't record this YouTube today, but I'm in my hotel room, and I'm looking out the window, and I see lots of construction around here. So, but I'm not really here as much on real estate. I'm actually having dinner with my oldest daughter, Lauren Thomas, who is as many of you know, she writes for the Wall Street Journal and covers M&A. So I'm really excited to meet with her and actually tour her and her husband's new home here. So really excited to be here. Then I've got some business meetings tomorrow, and then I'm headed to Chicago. I'll be in Chicago a couple of days this week. So it's a pretty big week of travel.
Yeah, well, you look sharp, and thanks for making time. I know it's hard to do this when you travel, and we look forward to the discussion today. The markets are in the green this morning. I'm assuming you've seen that. I know you just got off the plane, but another kind of boring day from a value investor perspective. I think there's fewer and fewer things to buy in the market right now. I know I'm having a hard time finding bargains. But I think Brad has a few companies that he really likes today, and that's what the discussion is going to be. So, Brad, I'll let you take it away and get us started.
Well, that's great, Nick. And listen, before we get started, I got to hear about your football. I know you were 1-1 last week. So, what happened this weekend?
We won again. So, yeah, 2-1. Spirits are up 47-0. So, big victory, back-to-back shutouts. It's funny, we talked about how important defensive was, 3 weeks ago, and maybe a bunch of my kids watched because they haven't given up a point in 8 quarters. We'll see how long we can keep that streak alive. Anybody that's ever coached high school football knows it's very hard to pitch a shutout. All it takes is one kid to make a mistake, and these are, 16, 17, 18-year-olds. They make plenty of mistakes, but they've been perfect for 2 games, so let's see what they can do moving forward.
Oh, I think there's some similarities between great coaching and great investing. So keep up the good work. And
yeah, we'll see. Well, I'll compare the win percentage of the team versus the win percentage of these wide-moat portfolios over the next 3 months and see how it matches up.
Well, historically speaking, that's going to be hard to beat, Nick, because as you know, our front end newsletter. And by the way, you can visit us at wide-moat-daily.com. That's our free content every day. And please check us out there at wide-moat daily. So, Nick, looks like this week, again, we're recording today, but by the time we publish this particular series, we'll know what the rate cuts are. But I'm predicting, and I think most people are predicting at least a quarter of a point. I think that's 80+%. There is a chance, an increasing chance of a 50 basis point cut. So we'll see what happens. But really, I wanted to dive today into self-storage REITs. The last 2 weeks, we've covered the healthcare REITs and we've covered the net lease REITs. And I've purposely covered those sectors because they've been beaten down a lot over the last couple of years. Now, net lease has actually outperformed year to date. Again, we're starting to see bids coming in because of the potential for rate cut. Now it's very, very likely of a rate cut. So now I want to switch from the long duration lease contracts, which are healthcare REITs and net lease REITs, over to the shorter duration contracts, which have pricing power, and that's the self-storage sector. So I had a lot of our audience asking for a couple of these self-storage REITs. So I said, hey, let's just cover them at another master class series, which I think will be really exciting. Not as long as last week, because we just don't have that many self-storage REITs compared to the net lease REITs. There's about 5 or 6 of them out there. We're going to be covering most of these, not all. And then there's 2 or actually 3 that I like a lot. Nick, I'm sure you're familiar with a couple of these names as well.
Yeah, if I, I have a good guess of what your two favorites will be. We'll see if I'm right here in about probably 10 minutes. But yeah, I like one good point you made. This video was driven by YouTube viewer comments. So if you guys want us to talk about something, please leave that in the comment section of the videos below, and we'll get to that. You, like Brad said, a lot of people have asked us about self-storage REITs. And I find that interesting because this is I mean, you drive by these things all the time, but I don't, they're afterthoughts for me. When I'm driving, I don't pay that much attention to them, except for when I'm doing research for a video like this. I kind of come back to think to where they are locally, et cetera. But this is a very interesting business model because unlike most buildings, these are kind of build and forget. They're just concrete, rectangles for the most part. Some have more bells and whistles, which Brad will get into, but you don't have to really pay any water bills. There's very little electricity bills. You don't have to really do a lot of maintenance. You just sweep them out and get the next tenant in. So from a cost perspective, this is one of my favorite kind of property subsectors because there's just not a lot that goes into it once the building is constructed.
Yeah, there's two charts I want to show you before we get started with these picks. First of all, you can see this chart here. This is the historical national occupancy for self-storage. Now it's trended down, but it's still fairly well elevated. And I think that's an important fact when you look at the overall occupancy for these facilities. Now, this is a very highly fragmented marketplace here. Now, the other chart I'm going to show you here, and this one jumped out. I was looking at the investor decks of all of these companies that we're going to be discussing. And this chart here is the steady demand growth. So you can see going all the way back to like 1987, there's only 2.7% of US households that were utilizing storage. But if you look at this chart, what's really interesting, that's 12.6% today. So we've seen a lot of households now starting to utilize more storage than they did before. Now, I think that's in large part to technology. And when I think about self-storage, I really think about the technology within these companies. Back many years ago in 87, I mentioned 2.7% users in the US. But we didn't have Facebook, we didn't have Google, we didn't have all this technology which drive these advertisements to those consumers. Basically, we had the yellow pages, and so back in 1987, if you really wanted to be a successful storage REIT, you had the name of the company being AAA Storage because that's the first name in the yellow pages. If any of you remember the yellow pages, so technology played a huge part in the growth of this sector. Now, the final chart I'm going to show you here, and this one is actually, you'll see it's kind of a color chart, a lot of different shades of colors on here, but I've highlighted all the property sectors. And you can see going all the way down over time, over the last really 20 years or even 15 years, the self-storage REITs have outperformed most all of the other property sectors. And the last 10 years, the data center REITs have outperformed, and industrial, again, tying that to technology. But the self-storage REITs have done very well over time. And we believe, again, they've been beaten down, but I believe now, especially with rate cuts coming, that's why I wanted to talk about this particular sector today, because I think for investors, this could be a really opportunistic time to begin to invest, if you aren't already, in self-storage REITs. Now, shares are down about 1% year to date. You can see right in the middle of this next chart, this is all the property sectors. I mentioned healthcare, net lease have outperformed. Healthcare is up 21% year to date. Net lease is up about 16% year to date. Self-storage right in the middle of the pack between all this property sectors, about -1%. So not that great. But again, that's what creates these opportunities. And the last chart I'm going to show is the comparison of all of the net lease REITs. There are 6: National Storage, SmartStop, Global Self Storage. We're not going to cover today. That's a very small cap, micro cap company. Public Storage, Extra Space, and CubeSmart. So now let's get the party started here with really one of my favorite picks is Public Storage. Actually, as I was driving into the city, I flew into LaGuardia, 45-minute drive up here to Central Park, where I'm located now, and I passed by several big orange colored buildings. And of course, everyone recognizes Public Storage by the orange buildings. That's ticker symbol, by the way, PSA. Now, this is the largest, most dominant player in the self-storage sector. They've got around $51 billion market cap. They're obviously an S&P 500 constituent. They always appear regularly in all the big market cap weighted REIT ETFs like VNQ. You'll see them in that top 10 exposure. And they've outperformed year to date. You can see a chart here. They're down 2.5% again year to date. Compare that with VNQ, which is the big basket of all REITs, again, market cap weighted, up 4.2%. Of course, the S&P is up much greater at 12.5%. Now, what I like about Public Storage is a couple things. When we talk about the moat advantages of these companies all of the time, hence the name Wide Moat Research. But I like to talk about the scale advantage here and the cost of capital advantage here. Again, Public Storage is the largest, most dominant player. They've got 3,300 facilities. They've also got a joint venture in Europe as well. But in the U.S., 3,300 individual units around the country. So definitely have that scale advantage. Again, in terms of the cost of capital advantage, they've got a fortress. And when I say fortress, they're an A-rated balance sheet, A2 and A ratings, strong credit metrics, 4.1 times net debt plus preferred to EBITDA, and 3.5% cost of in-place debt and preferreds. So even in this low or this high rate environment, they've been able to maintain a really strong balance sheet, which obviously generates very strong earnings and dividends. Now, just like I did last week with net lease, I spent some time putting together these earnings charts. This chart shows the AFFO, that's the adjusted funds from operations or earnings for REITs, and the dividends per share. And you can see that really predictable, reliable earnings growth going forward. Now, they did cut the dividend in the Great Recession, as most of the self-storage REITs did cut that dividend in the Great Recession very modestly, but they've done a great job at clawing back that dividend. And so over time, I think Public Storage will continue to deliver those very strong earnings. They've generated about 7.8% CAGR growth in earnings over the last 15 years and about 10% dividend growth over the last 15 years. So we like this company a lot. Again, we got this scale advantage. You've got the cost of capital advantage of this company. Again, you can see this fast graph here. They're trading at 18.9 times. Their normal valuation was 22.7 times, and their dividend yield is 4.1%. Very well covered. So we're forecasting Public Storage could return in the range of around 20%, kind of that midline range, 20% over the last 12 months, next 12 months. Now, again, what's the number one catalyst? Rate cuts.
Yeah, no, Brad, I know you talk to these management teams. Do you know these guys well or no at Public Storage?
I don't. I need to spend more time with Public Storage. They are harder to get. I think I've got a NAREIT conference coming up soon, but that's one of the I've spoken to most all of the other self-storage management teams, including the next name we're going to talk about here in just a minute. But I do need to spend some time with Public Storage. That is the most dominant. Of course, they're based on the West Coast, so they're harder for me to get to. But that's definitely a CEO or management team we need to be connected with.
Yeah, well, when you get a chance, my question was, they have a very different dividend growth trajectory than most of the REITs and just in general dividend growth companies that we cover. From 2009 to 2016, very consistent, 5 to 10% growth per year, like you would expect from a company with this type of earnings growth. However, then from 2017, I'm looking at the chart from 2021, flat dividend growth. They held it at $8. Yeah. Then they increased it by 50% in 2022. And then it's been flat for a couple of years, and analysts are predicting a pretty big increase over the next couple of years. So when you look at a 5 or a 10-year dividend growth CAGR, like you said, it's still respectable at, right around 10%, I think. But it's not every year. You have to wait for these big chunks now with PSA. So I'm interested to know why it is that they're doing that, or if that was, just because I know they did a big acquisition a couple of years ago, $11 billion. That could be part of it, but just something for people to know. We like this company. The best, most reliable earnings growth in the kind of subsector, when I looked at them, when Brad told me this is what he wanted to talk about, the only A-rated company, I believe. However, yes, the inconsistent dividend growth may bother some people, but it's just something you need to be aware of when thinking about buying these shares.
Yeah, you're right. I mean, coming out of the Great Recession, they did start to increase that dividend all the way up to about 2017, 2018. But you're right, they maintained a relatively flat dividend of about $8 per share up until the more recent dividend increased up to $12 a share in 2023. So you're right. There was a period of time. I think that you're right, Nick. I think that had to do with M&A. And by the way, I think M&A is going to be extremely robust here within the self-storage sector. We're going to see, I think, a number of these portfolios because most of the players in the self-storage sector aren't these big REITs. They're regionals, kind of smaller local to regional players. So I think you're going to see more and more consolidation overall. So I agree. The other thing I'll point out is public storage has a awful number, a lot of preferred shares. Their capital stack is primarily made up of preferreds, a lot of different preferred issues. I can't keep track of all the preferred issues. Most of the REITs that we cover that have preferreds have around 10% or so of their capital stack in preferreds. Public storage has much more. So maybe the management team feels like they're rewarding their retail investors with so many preferred different issues they've got. I don't know. That's just my guess. But they do have a lot of preferreds, which again, a lot of these retail investors like these preferred shares. Now, let's move on to Extra Space Storage, ticker symbol EXR, based in Salt Lake City, Utah. 4,179 properties, 322 million square feet, serving 2.8 million customers around the U.S., $31 billion market cap, so smaller than public storage, but also still an S&P 500 constituent. And you're going to see Extra Space in most of these large cap weighted REIT ETFs like VNQ, maybe not in the top 10, but definitely in the top 15 in terms of their size. And overall, they have also underperformed this year, minus 0.1%. So a little better than public storage, not much. And again, you can see those how they've compared with the VNQ as well as the SPY, S&P 500. Now, again, one of the things I've been covering Extra Space for a long time. And one of the things that I've really been fascinated with this company is their technology. They have over time or historically generated better growth than the public storage and their peers, because I believe a large part of that is because of their technology investments. I've toured many of their properties and 24-hour call centers and all the investments they've made to generate more customers for them and really build this brand. You can see now, in terms of the balance sheet, again, very strong balance sheet, not as strong as public storage, but they do have a triple B plus, almost an A rating, a notch away from an A rating. Strong credit metrics, 5.2 times net debt to EBITDA, and 4.3 times interest rate coverage for the company. I'm going to flash up this earnings and dividend chart, just like I did public storage and the net lease REITs last week. You can see here, again, coming out of COVID, they did cut the dividend again slightly coming out of the Great Recession. Again, but look how they've grown the earnings and the dividend since that time, and really maintained the difference between that orange line, which is their earnings or AFFO, and the blue line, which is their dividend line. They've maintained that margin of safety. That's the payout ratio that we talk about and refer to a lot, which is really important when it comes to the overall dividend safety of the company. Now, you can see, though, in the last 2 years, they've really maintained relatively flat earnings. So they just haven't grown. And that's one of the reasons that we've seen this kind of modest sell-off in the self-storage sector, and why this sector hasn't performed as well. Again, I told you historically over the last 15 to 20 years, self-storage had been, the golden child in the REIT space. But part of the reason for that sell-off is they just haven't been able to obtain that pricing power that we've seen with these other sectors. And again, a lot of that has to do with competition. But there's two interesting things I'll say about storage. There's been a lot of slowdown over the last 2 years in construction. So now you're going to see that demand pick up more because that supply is coming down. So those companies will now have more pricing power. And again, I'm keep going back to that rate cut because I think that's going to be the primary catalyst, and we'll know this week for sure. Now, in terms of their valuation, again, this is a very attractive company. You can see here with the fast graphs, they're trading at 19.3 times. Their normal is 22 times. So you can see here that margin of safety. Dividend yield is 4.4%, a little more than public storage, not much. So we do think there's an opportunity set between the dividend yield, the multiple expansion, and very modest growth. This company could generate closer to the 15%, maybe not as close to the 20% number that I just threw out regarding public storage. but I do think extra storage is opportunistic today.
Yeah, I think so much for both of these companies coming out during the COVID period, they saw demand soar. People were moving much more often. Rates were very low. People were buying second houses, working from home, et cetera. Every time there's a big migration that occurs, there's a lot of demand for storage centers because anybody who's moved understands how that works. You probably need to put your stuff away while you're waiting for your deal to close, et cetera. They saw 35% AFFO growth in 2021 and then another 23% in 2022. So, yeah, we've seen a couple down years here, but and I know I hate to see that. I like to see growth every single year. But if you go back to 2020, AFFO was 489. It's expected to be 764 this year. So if you do a 3 to 5 year CAGR on this company, even with the last couple of negative years that we've seen, it's still really good performance. And analysts are expecting to see them get back to kind of normal mid-single digit growth next year, probably due to rate cuts, right? We expect to see the property markets, the residential real estate markets heat up, and that's a good thing for these companies. So, yeah, I like this pick. And you touched on technology, Brad. I know you've told me you've toured these facilities. EXR, I think maybe more than even PSA, has adopted the on-site technology too. We talk about property tech. There's not even workers at some of these places. You can sign in, you can buy your storage center on your phone or your iWatch even. You can go check in digitally. You can open up your thing digitally. You can control the climate, the lights, etc. So they've done a great job, I think, with embracing prop tech. And then that also lowers costs for them after those initial investments because you don't need property managers. You can have like a regional property manager to cover a whole bunch of sites instead of having people working at every single one. So, in the big tech space, we talk about automation and, hurting the worker, but boosting the profits of the company. And I think you see that in the self-storage, REIT space more than probably any other, subsector of the broader REIT, kingdom.
Oh, absolutely. And again, these companies are kind of REITs, quasi-retailers. I mean, they really cater to the consumer, and they're using all of those tools via the omni-channel, just like the retailer, to get those customers in, but also to maintain those customers and to really maintain the brand of these particular REITs. So I think this is a huge advantage to the REITs. I've got friends of mine who are developers and investors in smaller self-storage, and I keep telling them I would never want to compete with these big REITs. Knowing what I know about the technology for these companies, the investments they've made, I would never want to go compete with them at all. The third one is CubeSmart. That's ticker Cube, CUBE. CubeSmart, again, third largest player. They've got 1,500 self-storage facilities around the country. Just in the US, that's 48 million square feet. Now they've got a market cap of $9.4 billion. And again, they're differentiated by their strategic focus on these submarkets that have very attractive demographic trends. So they're kind of like sharpshooters. They're not as big as Public Storage or Extra Space, but they're in some really attractive markets with strong growth opportunities. Again, from a performance perspective, again, CubeSmart has also underperformed minus 2.7% year to date. And here's the other two I mentioned, V&Q and SPY. Again, they have this technology advantage just like the others, where they meet these logistical needs of these customers through these innovation products as well as customer service. Now, like the larger peers, CubeSmart also enjoys this sophisticated, enhanced platform that drives efficiency. This allows the company to attract significant share of demand across channels as well. So I think in terms of technology, CubeSmart has done it too. I'm very familiar with CubeSmart. They've got properties all up and down the Southeast as well as my hometown. In terms of performance, now, CubeSmart was also a victim of the Great Recession like those other REITs. You can see here on this earnings and dividend chart, AFFO declined actually fairly significantly compared to the others, Extra Space and Public Storage. But they clawed that back, and they've been able to continue to grow earnings and make that dividend safer. Now, again, they've had relatively flat, even actually declining earnings over the last, say, 2 years, since 24, 25. So we're not seeing a lot of modest growth here, but that's what's made these shares cheap. Again, shares are trading at 16.5 times. You can see here on Fast Graphs, the normal multiple is 20.2 times. Dividend yield is a little higher than the other two I mentioned. This is a 5.1% dividend yield. So we're modeling CubeSmart to return somewhere in 15 to 20%, just like the others. Now I'm going to move on to the fourth one. And actually, I have one more kind of at the end that's a new company. But this fourth one is National Storage. Now, this is a company I'm avoiding, and I'll tell you why. National Storage has over 1,000, actually 1,067 properties in 37 states, as well as Puerto Rico. Smaller than the other three, $2.5 billion market cap. They've got this program. They call it the Participating Regional Operator, or PRO program, which operates as kind of like an umbrella company for a lot of these regional chains. So what they've been able to do successfully over the years is consolidate a lot of these regional chains utilizing kind of the external management arm of National Storage, and they've maintained those brands. So they're able to benefit from that umbrella. But again, these operators kind of operate more like partners, and also NSA uses a lot of these OP units, so they get those partners to come in as shareholders in the company. You can see here they've underperformed actually fairly massively, minus 15%, almost 16% negative. That's negative year to date. So really not performed well. Again, you can see how they've compared to the VNQ and SPY. Again, in terms of their debt, they're higher levered than the other REITs. They're trying to bring that leverage down through some strategic sales of assets. But again, this is the alarming part, and why I'm avoiding this company right now. The dividend payout ratio is 107%, and that can be highlighted with this chart here, the earnings and dividend chart. I've shown on the other three. You can see they've crossed. Now the dividend, the blue line, is above the orange line, which is the earnings or AFFO line, which means that dividend is not very safe. So we're avoiding that company. You can see the market hasn't liked NSA year to date. And again, we're forecasting and predicting a dividend cut's likely. So not going to spend much more time on that one. The last one I'm going to go to is SmartStop. Now, SmartStop is actually led by a guy that I know fairly well. I've known him for a number of years, Michael Schwartz. He had several large non-traded REITs that he sold one portfolio, actually to Extra Space, a couple of years ago. I remember that transaction. And they listed this current portfolio of 230 properties, or 18.7 million square feet. Just listed that fairly recently, a couple of months ago. So we don't have a lot of historical data we can rely on. They're also in Canada as well. That's another differentiator for SmartStop, is they've been able to penetrate the Canadian market, which has a lot of growth opportunity as well. Again, the shares listed on April 3rd, and they've outperformed. You can see this chart. Again, this goes back just through April 3rd when they listed. They're up 19.1%. Market really likes them. VNQ's up 1.8% during that time. S&P 500 is up 16.5%. So they've actually outperformed the S&P 500, believe it or not, since they listed on April 1st. So we're looking forward to continuing to cover SmartStop. I think that could be a really opportunistic self-storage REIT over time. And that really concludes the self-storage picks today. Again, there's really three that I like. I still go with those top two, Public Storage and Extra Space, the dominant players. Again, you've got consolidation. We're going to see more and more M&A opportunities. So there's a potential growth. Again, we're starting to see the construction have really been muted. So that's going to create more opportunity for these REITs. They're not going to have as much competition. And again, we go back to the number of users today. Again, you've got over 12% of the U.S. population now utilizing self-storage. And finally, look, I know this video is going to publish a day after the rate cut. But again, we're going to get a rate cut, whether it's 25 basis points or 50 basis points. And I think that's going to be the rocket fuel for REITs. So, and I think self-storage REITs are really going to take off as a result, as they begin to lower their cost of capital.
I think, like you said, sometimes we talk about KISS, keep it simple, stupid. Don't want to insult anyone, but this one is so simple to me. There's two with the very high credit ratings, with the very long earnings growth history. Like you said, with National Storage Trust, the AFFO is not expected to cover the dividend this year. So that's a very easy, just X that one out to me, right? Yes, they're much cheaper than their peers, but it's not worth it to me. Dividend cuts, we know what happens when companies cut the dividend. Most of the time, the share price falls as well. I don't think either one of us think a dividend cut is likely from PSA or EXR anytime soon. So this is an interesting sector. I look forward to see what happens later this week. We record these on Monday, so we don't know what the Fed's going to do, but I think we're both expecting a cut. Like Brad said, we've seen the calls and the data pointing towards 50 basis points rising from 0% just a couple months ago to, I think, 15, 20% right now. That would be very interesting. We'll obviously focus on that if that's the case. But in the meantime, I think rates are definitely falling. That's good for REITs. It's good for utilities. It's good for consumer staples. So, just be aware of that moving forward. We'll see what happens. And, I look forward to next week's video where we'll have some more macro news to actually talk about instead of just speculating on.
Sounds good, Nick. Thanks again for joining me here, and thank you all for watching. I'll be back home next week, and looking forward to the upcoming week here in New York and Chicago. Nick, congratulations. We're looking forward to 3-1 next time, and good luck. Yeah, well, thank you all for joining us here, and we'll see you next week. Take care.
Yep, take care. Appreciate it. Thank you for tuning in to this week's episode of the wide-moat show here on YouTube. If you enjoyed our content, please like and subscribe to our channel and leave a comment. We'll be sure to get back to you ASAP. Also, please sign up for the wide-moat Daily. That's our free daily newsletter at wide-moat-daily.com. That's where you'll find Brad and I's insights on all sorts of things published every day in the evening. So thank you guys for stopping by, and we'll see you next week. Happy Swan investing.